Welcome to the Topic 7 workshop. So today we're going to be doing is looking at applying some intrinsic valuation models. Now in front of you, you see the Excel spreadsheet that you can download from iLearn. And right now I'm on the discounted cash flow sheet, which is, I guess, abbreviated as DCF. Now this worksheet is structured quite simply. At the top, we have some assumptions that are going to be going into our discounted cash flow model. So we have the discount rate, or the WACC in this case, the perpetual growth, which is the long-term growth rate for our cash flows, and also how many years we're going to be forecasting. In this particular case, I've set it up to be 5 years. Now, the first thing that we need to calculate the net profit and effectively get it back to free cash flows by making some adjustments. We've technically already done this part in our forecasting week a few weeks ago. We then need to estimate the discount period, the discount factor, to get back to the present value of our cash flows to adjust for the time value of money. We then calculate the enterprise value, which is equal to our present value of our free cash flows that we already forecasted, plus the terminal value as well, which is essentially just assuming the fact that the company will continue on forever and not just, I guess, suddenly end in 2020. Based on this, we'll be able to calculate the enterprise value, and the enterprise value is the total firm value. But if we wanted to estimate the share price that we believe is, I guess, appropriate for this business, we need to get back to the equity value, which we calculate here on the right. And we do that by adjusting the enterprise value for the total debt and cash equivalents. We then get the equity value, which we divided by the shares outstanding to get the share price. The second model we'll be applying is the residual income valuation model, which is structured very similarly in the sense we have a set of assumptions. We have, I guess, the thing that we're interested in, which is residual income in this case. And again, we're discounting it back to the present period. And to get the equity value in this case, we again sum the, I guess, the present value of the residual incomes we've actually forecasted, but also consider the fact that there must be a terminal value, and the, I guess, the total value is equal to whatever we forecasted in terms of terminal values, in terms of, I guess, our forecasted values and the terminal value. And again, we get the present value of equity, which we divide by shares outstanding to get an estimated value per share. So if we go to the discounted cash flow model and start here quite quickly, what we can do is we can set a set of assumptions that we need to, I guess, use for the discounted cash flow model. Now, what's important to know is that you've already, I guess, done a lot of this hard work for yourselves back last week. So the WACC you can just get for your own company based on what you calculated last week. In this case, I might just take an assumption of 6%. The perpetual growth rate is the long-term growth rate for the business, which is essentially going to continue on forever. We tend to say that this should not be much above inflation. So if you want to be conservative, you would set this at inflation. If you want to be generous, you might say like 3%, like I do in this case. The forecasted years is how many years are we forecasting? In this case, it's 5 years that we forecasted. Now, the first thing that we need is to effectively get the unlevered free cash flows to the firm, because this is the line item we'll be valuing. But to get to the unlevered free cash flows, we essentially start with net profit and adjust it for non-cash items. Now, technically speaking, this part, we've already done all the hard work in the forecasting week. So if I say equal to in C8, I'm just going to reference back to the forecast week, so the forecast sheet. In cell H37, in my case, I've already estimated the net profit for 2016. And if you see down here, you can see that I've already made all the adjustments necessary to get back to unlevered free cash flows. So all we need to do is press enter, and that references net profit in 2016. I can obviously also drag it down to also reference all the way down to free cash flows. And I can then drag this whole selection to the right to reference the first 5 years. And that is effectively, I guess, the first part. The next part that we need to consider is the discount period. So the discount period is how, I guess, far in time is this, I guess, financial year 2016. So what we need to consider here is that it's technically not 1 year into the future, but only half a year. And the reason for that is that technically these cash flows, they don't just suddenly arise at the end of the year. We accumulate them throughout the year. So if we wanted to discount them back to the present value, if we were to take a discount period of 1, we would discount them a bit too much. So what we usually say is that the discount period for the first year is 0.5, because on average that cash would have received, mid-year. For the second period is 1.5, third period 2.5, 3.5, and so on. The discount factor, on the other hand, is effectively the multiplier that will apply to the unlevered free cash flows to get them back to the present value. So to calculate the discount factor, you take 1, you divide it by 1 plus the WACC, close the bracket, and you raise it to the power of the discount period. So in this case, it's 0.5. What I would also say is that it's important to lock cell C3 in this particular formula, because we can then drag it to the right. So it's 0.97 for 2016, and then 0.77 in 2020, which means that technically in 2020, even though we make 14,341, that amount is only worth 77% of its value in today's dollars. So again, we can then start to use this logic by multiplying the unlevered free cash flows by the discount factor to get to the present value. And we do this for all the years. Now, to get to the enterprise value, we need to not only consider these 5 years that we've already forecasted, but we also need to consider what happens afterwards. So what happens in the year 2021 and beyond? So to do this, we first just start up by quickly summing the present values we've already calculated, manually. So that's 67,015. But we then need to consider what happens in the future. So in 2021, our terminal year free cash flow will simply be equal to our cash flow in 2020. And we're going to multiply it by 1 plus the perpetual growth rate, which we have in cell C4. Press enter and you get 14,771. Now next we need to calculate the terminal value. Now the terminal value is going to be equal to the terminal year free cash flow, and you divide it by, open up a bracket, you take the WACC and you subtract the perpetual growth. And you get a terminal value, because this is the value of the perpetuity stream, that's from 2021 and onwards. We then need to apply a discount factor to this terminal value, because currently we're valuing it in 2020 dollars. So we need to get it back to 2015, and to do that, we need to calculate a discount factor. And to do that, we take 1 divided by, open up a bracket, 1 plus the WACC, and then to the power of, in this case, I'm going to reference my forecasted years, which is 5, because I need to get it back 5 years prior. And that gives me a discount factor of 0.75. Now the present value of the terminal value is then just equal to the terminal value multiplied by the discount factor. The enterprise value, on the other hand, is equal to the cumulative present value of FCF, which is essentially our forecasted present value of free cash flows, plus the present value of the terminal value, which means that the enterprise value of our business, which in this case is H&M, is 434,940,000. Now the equity value, on the other hand, is different from the enterprise value, because the equity value is only concerned about what the equity within the business is worth. Now to adjust the enterprise value for the equity value, we again start with the enterprise value in this case. Then we have to look at how much debt do we hold, because we want to subtract this. In H&M's case, if you remember from the prior weeks, you know that it technically doesn't hold any short-term or long-term debt. But again, if you want to do this for your own company, you'd go to the balance sheet, In this case, it's my cell H42 or short-term debt. And then I would find the long-term debt, which is in cell H50 in my case. And I would add these two together, and this will be my total debt. We also need to add back some cash. So any cash or cash equivalents are effectively something that, I guess, increases the equity value. So in cell, let's see, H8, we have a row called cash and cash equivalents. So I've referenced that, and that gives me my cash and cash equivalents. For the equity value, what you effectively do is you take the enterprise value, you subtract the total debt, and you add the cash and cash equivalents. Now, to get to the share price, we just merely need to take the shares outstanding, which we can get from the balance sheet. So go to the balance sheet. If you go to the bottom of it, you'll see that in my case, we see that shares outstanding is in cell H75. This gives me my shares outstanding, which means I can divide my equity value by shares outstanding, and it gives me a share price of 270 Swedish kroners in this case. If you benchmark it to the actual share price, it's actually not too far off. So this is part one, and part two is to instead apply the residual income model. Now, residual income model, the structure is very similar, except that we're looking at residual income instead of cash flows. So again, we need a set of assumptions. Instead of using WACC in the residual income model, we're only concerned about the equity portion of the business, so we only need the cost of equity. Again, I'm just going to make the assumption that it's 6%. In your case, you need to look up what is my company's cost of equity. Perpetual growth, again, similar to the discounted cash flow model, we're going to use 3%, and forecasted years, similarly, we're using 5 years in this case. Now, the structure of this residual income valuation model is slightly different. So we start with the net profit, but we then need to look at how much did we have in beginning book value, or I guess our total equity, because this will allow us to understand what is the required net profit to compensate the equity holders. So to explain this, it's probably better to just go through an example. So in 2016, our net profit was, if you go back to forecasting, 2016 H26 is our net profit. Our net profit was 23,948. Now, in the residual income model, this does not necessarily mean that we've actually made an economic profit. So even though it's a profit, we need to consider how much are the equity holders actually expecting. To get this, we need to figure out first, what is the beginning book value? Well, the beginning book value is merely the previous year's ending book value. So this we can reference from the forecasting sheet. And this will be in cell, let's see, G31 in my case. So it's the total equity, which is your book value, at the end of 2015, because this will be the beginning book value of next year. So to get the required net profits, what you do is you take the beginning book value and you multiply it by the cost of equity. Now, in this case, I recommend you guys, again, lock cell C3 so that we can then drag it to the right, which means that the required net profit from the equity holder's perspective is 3,483. So to get the residual income, we compare the actual net profit with the required net profit by subtracting it, which means that the residual income is 20,465. Now we can highlight these 4 cells, we can drag them to the right, and it should all be calculated for us for the next 5 years. The discount period is similar to how we use the discount periods in the discounted cash flow model. So the first year is 0.5, then 1.5, 2.5, 3.5, and then 4.5. And discount factor, very similar in terms of how we calculate it. We take 1 divided by 1 plus, in this case, cost of equity to the power of the discount period. And again, remember to lock cell C3 by using the dollar signs. Click enter and you get 0.97, drag it to the right to get the, I guess, discount factor for the future periods. Now, the present value of a residual income is merely our residual income multiplied by the discount factor. So again, it's very similar to the discounted cash flow model, except that instead of looking at cash flows, it looks at residual income. Now, similarly, the first thing that we do to get a share price, we first need to figure out what is the sum of our forecasted present values, but also we then need to figure out what is the terminal value as well. So first we take the sum of the forecasted present values, which is 90,491. The terminal value, on the other hand, is going to be equal to what we believe is going to be happening in the future. So similarly as how we did it for the discounted cash flow model, we're looking at what is the terminal, or in 2021, residual income. Well, we haven't forecasted it, but we do have the perpetual growth. So the terminal value will be equal to the residual income in year 2020 multiplied 1 plus the growth rate, close that bracket, and you divide it by, to get it into perpetuity, the cost of capital. In this case, we're looking at cost of equity minus the growth rates. So cell C3 minus C4. Press enter and you get the terminal value of 670,210. Now the discount factor for the terminal value is going to be again equal to 1 divided by 1 plus the discount rate, which is in this case in cell C3, to the power of cell C5, which has the number 5 because we're discounting it back 5 years, which means if the terminal value is worth 670,000 at the end of year 5, to get it back to the present value, we need to multiply by the discount factor, and that tells us that the present value of the terminal value is 500,820. So the total discounted residual income is merely equal to the cumulative present value of residual income plus the terminal value in its present value form. So cell C17 plus C20. We then need to consider the fact that we actually have some book value at the beginning of the period, which we add to our total value. So beginning book value is in cell C9 in this case, which means that the present value of the equity is going to be equal to our total discounted residual income plus whatever resources we have at the beginning of the period. Now to get to the share value, again, we need to get the total shares outstanding, which we can get from the balance sheet. So if we go down to cell H75, so our estimated value per share will be equal to the present value of equity divided by the number of shares outstanding. In our case, we're estimating to be valued at 392 Swedish kronor per share. That's effectively it for this week's homework. I don't think it was too difficult because, again, we've done most of the hard work already in the previous weeks. Again, when you finish, just upload your complete homework to iLearn.